Hello, my name is Shreyans, and today we are going to talk about a company which is one of the India's largest in terms of revenue, profit, cash flow, even market cap. And very recently, it became the largest company by market cap in its particular industry, not just in India, but in the entire world. So that is how big that company is. The company that I'm talking about is TCS, or Tata Consultancy Services. It's probably one of the two largest companies in India, second only to Reliance, I guess, in terms of market cap. And for some time, it was also India's largest company by market cap as well. And as you know, what TCS does is it provides IT services, consulting, and business solutions to companies. What it basically means is they create software-based products and platforms for company to manage their operations on the network, right? And a lot of these most of these services are actually provided to very large companies in outside India as well, in the US, in Europe, and other places as well. So it's primarily a B2B company. The IT services industry in India is primarily a B2B space, right? So let's get started with the financials, then we'll look at metrics, and then we'll wrap up with the highlights. So if you look at the revenue, so the company's revenue has gone up by 4x in the 10-year space. So it's a very healthy growth rate, so to speak. So its revenue is around 1,56,000 crores, right? And the growth rate in EBIT and PAT hasn't been as good as compared to revenue. So I mean, some sort of growth was kind of lost there, right? So a 17.3% CAGR in revenue, but a 15.8 and 15.2 CAGR in EBIT and PAT respectively. So slightly lower, but still very good overall growth rates, so to speak. Right now, if we look at the CFO, so CFO also has a very strong growth rate of about 4 point. It has up 4.9x, so very good growth in CFO. And overall, if you look at it, then the CFO hasn't been in up to the mark of PAT. So in most of the years, actually, the cash flow has been lower than PAT. Although in the recent years, it has kind of reached very near to PAT, and the cash conversion has improved in the recent years. And briefly for this year, it has actually exceeded PAT. But on an overall basis, the cash flow from operations is close to 1,90,000 crores, the cumulative for 10 years, and the PAT is around 2,12,000 crores or 13,000 crores on a cumulative basis. So cash conversion is one place where the company can improve, and again, this is something that you would find in other major IT companies as well. Now, talking about cash flow from investing and cash flow from financing, so most of the transactions that you actually see in cash flow from investing aren't related to fixed assets. Of course, the company has continuously reinvested into its assets, but most of the transactions with respect to the larger amount or the larger proportion is related to investments. So if you could see that the company has continuously been reinvesting not just into assets, but it has also been placing all the excess cash that is producing into investments, into short-term investments, or some into long-term investments as well. Because these companies generate a lot of cash, the IT companies, and they don't need a lot of resources, in order to grow, because their most important resource are actually human resources, the engineers, right? So that is why they don't need to make very high reinvestments in order to grow as well. They just need to increase their employee base, rather than increasing their asset base significantly, so to speak. Right now, cash flow from financing is mostly related to shareholder payments. So this includes dividends also, and the company has done share buybacks also in the recent years as well. And it recently announced that it is going to do another round of share buyback as well. So that is there have been very few borrowing related transactions or very few liability related transactions, so to speak. Coming to the balance sheet now, so if you look at the equity is up 3.4x, and if you look at the equity position, then in the last 4 years it has more or less been around the same space, because the company has been paying out so much of dividends and buying back of shares as well in a couple of years. Right, current assets very significant. So if you look at the current assets, they've gone up from about 17,000 crores to 90,000 crores. And again, if you would look at the breakdown of this, there would be a lot of investments in the current assets, right? Non-current assets, continuous reinvestments again into assets, but not on that scale. So if you look at non-current assets, they've gone up by only 1.8x, so to speak, right? And if you compare that with revenue, the revenue is up 4.2x. So this is the thing that I was talking about. They don't need to make significant investments into assets. They do make investments into assets, but then their major resource are the humans, the employees. And if you look at the non-current assets, then this was kind of declining in these years, right? Because the company probably did not make any major expansion. And in this year, the company has undergone a series of or another phase of expansion, so to speak, in order for the next round of growth. Right now, talking about current liabilities, the movement in current liabilities is very similar to the movement in revenue, nothing extraordinary there. And non-current liabilities are just insignificant, so to speak, right? Just one specific or one sharp increase in this year. And because I've studied the company in a bit of detail as well, I know that this is related to increase in leases. So the expansion that has taken place, a lot of that has been done via using leases, so to speak, instead of outright purchasing assets. It's a finance lease, so the company will have to make lease payments, but still the non-current liabilities are very insignificant. So if you look at the current liabilities, they are, or the total liabilities are about 35,000 crores, and just the current assets are about 90,000 crores. So this is the sort of cash generation or investment position, so to speak, in this industry, and particularly this company, because it's the largest in its industry, right? Now, talking about the growth rates, so if you see the growth rates, there is a sort of split story in the few years here. So these years are very solid, so to speak, although there was a poor year here in terms of EBIT and PAT, but still overall these years are very good. But the recent years haven't been the best, right? So FY19 was good, but FY17, FY18, and FY20 weren't the best, very single digit or very low growth, so to speak, right? And degrowth in PAT in one of the years as well. And it will be interesting to see how this changes in FY21, because a lot of digital transformation is happening rapidly across industries and across companies, and obviously IT service companies are going to be the beneficiary of this. And this might last for another 2 or 3 or even 4 years. That's something that we'll have to see, right? Good growth in equity, I mean, that is very understandable. Stable equity in the last 3 years, that is what we also found out. Mostly good reinvestments into assets as well, and but the most of the growth in assets are actually driven by the current assets rather than the non-current assets, right? Current assets less current liabilities, I mean, the growth there is okay, understandable, but from a liquidity position, it is very, very comfortable. Liabilities, although the growth numbers seem very high here, but then the absolute amounts are very, very low and almost insignificant, so to speak. Now, coming to the metrics and starting with the return on capital and return on equity. So, if I've studied a few other IT companies as well, and no other company has, the return on capital at the scale at which TCS generates, right? So, its median is around 42%, and its median ROC is around 42%, and median ROE is around 35.5%. And these are staggering numbers. And if you see that the company has been able to maintain these numbers, obviously there has been volatility, increase and decrease, but still largely the company has been able to maintain such high return ratios, and that is why it is able to generate so much cash, excess cash, then gets placed into deposits and so on and so forth, right? If you look at the margins as well, again, TCS has one of the best, if not the best margins in the industry. It's the leader, and that is why it is able to take use of scale like no other IT company is able to do so. And the margins have again broadly been maintained. They are more or less near the median, only slightly lower than the median in the recent years. So slight decline in margin, if you could call that, but broadly the margins, both the EBIT margins and PAT margins have been maintained. And these are very good margins if compared within the industry as well, right? Capital turnover and asset turnover, if you look at it, again, both of these have more or less been operating within the range. So while the margins are on the lower side of the median, the asset turnover and capital turnover are on the higher side of the median, and it's one of the highest on towards the higher end in an overall basis in the 10-year period as well, right? So that is why the company is still able to maintain its very staggering capital return on capital ratios. Assets by equity, so solvency position, so to speak, very comfortable solvency position, right? The company's liabilities are easily covered. The whole liabilities are covered by the current assets only. And in fact, the company might even have the investments that are excess investments that have been placed, those might in fact easily cover liabilities. So that is that is a testament to the such a strong solvency position, right? CFO to PAT, this is something that we saw. So in the initial these years here, the it was not the best, but it has slowly started improving. And in the recent years, it has been on the higher side. It has been greater than the median here. And this is something that we have to see, is that how the company is able to further consolidate its cash conversion, because that is one place where the company or even the industry lags slightly behind the other a couple of other industries, right? Net cash flow position, which is all the flows, operating, investing, and financing flows. So again, it is a positive sum, and the company just generates so much cash that it is able to, there are not, the reinvestment requirements are not very high. The company is able to pay its shareholders a lot of money back, and still it is able to maintain growth. So from that perspective, the cash generation has been very strong, the reinvestment has been decent, and shareholder payments again have been very strong, right? Current assets less current liabilities. So if you look at there has been just significant jumps from year after year, and a lot of these, and this is not exactly the working capital, so to speak, because primary component of current assets, if you would look at it, would rather be investments, right? So, and that is the excess cash that is being placed there. So please don't mistake the difference between current assets and current liabilities as working capital, because a lot of that is actually not used in operations, right? Talking about the non-current liabilities to equity, very strong, very comfortable solvency position. I mean, the non-current liabilities are just insignificant versus the equity, right? So these were all the financials and the metrics. Now let's quickly wrap up with the highlights of the company. So strong revenue growth, decent EBIT and PAT growth as well, as we've seen, but low growth in all three in the recent years, right? In fact, in 3 out of the 4 recent years, it has been on the lower end, right? Single digit or degrowth. CFO is less than PAT in 9 out of the 10 years. Cumulative CFO is around 89% of cumulative PAT. So the cash conversion is improving, but this is something that can be further consolidated. Continuous reinvestment into assets, but primarily investment transactions. This is the explanation for the cash flow from investing activities. So the company places huge amount of cash as deposits and then or as investments, and then sells it as well. So that goes on year after year, right? And CFF primarily includes shareholder payouts. So there has been both dividend payments as well and share buybacks as well, because the company does have so much cash that it can do that. Decent growth in equity, this is something that we've seen. And although equity, the book value of equity has been fairly stable in the recent years because of a lot of shareholder payouts. Immaterial leverage or liabilities, as we've seen, and significant investments held as current assets. Again, this is something that we've talked about. So return on capital greater than 35% and return on equity greater than 30% in each of the last 10 years. And if we look at the lowest numbers, then 35.3% and 30.3%. So that is the amount of return that the company is able to generate on its capital. So if we think in terms of multiples, so the company can generate enough profits in 3 years to cover its capital base, right? So 1/3 of capital gets generated as profit every year, and that is very staggering, obviously, for any company to have such strong returns on capital. So the EBIT and PAT margins have broadly been maintained around, so EBIT margin around 26%, PAT margin around 21-22%. These are one of the best in the industry for sure. And let's see how this moves in the coming years, right, with the growth as well. Capital and asset turnover also have broadly been maintained. So capital turnover around 1.58x and asset turnover around 1.22x, right? So the conclusion for the company is it has very strong financial position, right, in terms of leverage and solvency, very good performance as well in terms of return on capital, very good shareholder payouts as well, continuous buybacks or dividends, whichever the company does, but limited growth in recent years. Now the growth could change in the coming years, and this is something that has been indicated by all the companies in the IT space as well, but this is something that remains to be seen, right? And one important thing to understand here is that the growth in any IT company is a function of two things. One is the actual growth, and the other is the depreciation in rupee. Because even for TCS, most of its revenue comes from Europe, and actually majorly from North America and some bit from Europe as well. So whenever rupee depreciates, companies like these benefit. So whenever you analyze the growth in any IT industry company, look at the constant currency growth, and then also try to separate the growth due to depreciation of rupee, because that will give you a better picture of the growth of the company. So that is all that I had to share about this company. I hope you found this helpful. The link to the Excel sheet is available in the description. If you have any questions, please drop them below. And if you're watching this video for the first time, or if you're watching any video by me for the first time, then please do subscribe. I cover new companies almost on a daily basis, and you wouldn't want to miss that out. So thank you so much for watching, and I'll see you again with another company.